Good weekend, all. Ira Epstein of Linn Associates with your agriculture wrap-up. And this is your weekly edition. It comes out on Fridays. We'll cover one monthly chart, and then all the others will be weekly. Sorry, I said that wrong. Today is Friday, March 20th, 2020. And I've got to tell you, we just had in Chicago the stay-at-home notice issued starting for tomorrow. So until April 7th, getting back into offices and the like is going to be very, very difficult, if not impossible. So you'll say, what am I going to do? I'm still going to put these out, but you're not going to see my face. Instead, I'll talk over the charts. I'll bring you to where we're at. I'll have a cursor on there and walk you through those. There's nothing else I can do because I don't want to make it look hokey. I mean, this is a whole studio. The funny part is we were moving this studio this Thursday. If they can still move it, I'll have it moved, and by this weekend we'll have this look back. Otherwise, for whatever it takes, that's how we're going to work. All of our brokers work remotely right now, so there's no changes. But if it's ghost town already, wait till tomorrow when the order goes in at 5 o'clock in Chicago. So we've joined California, New York, I think New Jersey and Pennsylvania in these big shutdowns, and that's what they're doing. The grains were interesting this week. They're the first markets that have started to find something of a semblance of a trade bottom. Maybe more than that. Maybe they've done it. Now, there's reasons for it. China began buying from us our corn and wheat. They have also, under the word unknown destination, bought a lot of soybeans. It's not the amounts we want yet. 700,000 metric tons of corn is not the monster purchase, but it's the beginning. These purchases are coinciding with their ports reopening, and they're fully to the other side of the COVID. We keep hearing scares that maybe it'll return there. Well, you can't play for the return. What you got to play for is what you have. And right now, they're at the other side. They need foodstuffs. They got to get their economy back to normal. Unfortunately, where I'm not in full agreement is how do you export anything if we put into the ports and we say workers can't show up there? That scares me. I'm not saying it's happened, but something you always think about. When we take a look at a monthly chart of soybeans, well, for the month, the market finished off down 20 some odd cents, as you can see, back in here to this 862.5 area, not too far from the 18-month moving average of closes in red. I'm not surprised at that. We had talked when we were doing charts earlier, when we were during the week, that this area, if you broke through it, maybe you're going to get back into this whole area, and the market certainly made the run for that. Okay, I don't know that it's got a lot left from there. If it does, it's the $8 zone. We'll see what happens in that zone. But so far, the market came down. I wouldn't be surprised if the market tries at some point to get back into and fill some gaps in the chart. Is the trend down? You betcha. You've had lower highs, lower lows. Where's the market? Once it got under the 18-week moving average of closes, you had one test back for it, couldn't do anything, and that's when the market let go. Where's potential support? Right here, the lower Bollinger Band. Markets will trade within these black bands 95% of the time. It's an algorithm that looks at range, volatility. Go on Investopedia, type in Bollinger Bands, it explains it. Let's assume the market rallies from here. Resistance 892 to 896 3/4. To break the downtrend, you'd have to take out 900 3/4, $9 3/4. But you couldn't start an uptrend. You'd still have a lower low and then a higher high on the weekly chart. What about momentum? It's pulled itself like a horse. It is now starting to go sideways. So you've lost this bout of downside momentum, and now it's starting to pull in, and maybe it's even ready to turn up if this red line can cross the blue on a closing basis. Could be interesting. In the meal market was caught in this sideways action. The resistance, the upper Bollinger Band, 100-week average. You got over both. You finished 925 over both numbers, but you typically stay within them 95% of the time. Something else. This is called a base now. Let me come back to this. If you can break out to the upside and stay over the Bollinger Band one more week, then I'm going to say you've had a breakout to the upside, momentum's up, bias is up, and on pullbacks, all I'm looking for is the market to hold that, if it even gets there, that 18 week moving average of closes. This chart's friendly, plain out bullish. Not so in the oil. It is still the laggard, but as the laggard, notice how it's trying to pull back into the Bollinger Band. Wouldn't be surprised if it does. When you do the crush spread, do you need the oil or the meal? It's rare that you have both demand for. You could get it, but it's rare. So this is the market that they haven't needed. Then we get to the corn market. Now, corn has been trading sideways for a very long time on a weekly chart. It tried its breakout right here. The market at the end of the week finished at what, 343 3/4, still under the lower Bollinger Band, but I wouldn't be surprised the way it's acting that it doesn't want to pop back at it. To get a downtrend going, I still need to get a pattern that doesn't have a higher high and a lower low. So I see an attempt at a downside breakout, but not the pattern I'd want as a chartist. In the wheat market, I had a full rejection of the downside. This is what we looked like last week. If you continue down, you're looking for the 100-week average in green and the lower Bollinger Band to try to be a support zone, and it did its job. It also came back with such a vengeance that it broke the downtrend. Now you have a higher high and a lower low. I look for resistance just where it went. 544 3/4 is it. You went to 547 and you're stalled out there, but you're out of the downtrend. So this whole pattern of lower highs, lower lows finished itself. This is where it was coming in. I think the pros got out, and I don't know what they're going to do now, but I don't think they're short anymore. Sugar, still a market on what we call a vertical price break. Hasn't even given you a bounce week after week. It just peaked out here, and it's come down almost a third in price. As a chartist, I probably don't get involved in markets that have moved a third on you unless you're really going to be nimble in them. So I'd be a little careful there. Coffee, doing way better than I thought. You know, I thought coffee was going to do the old scenario this week of America's getting bad, so instead of holding on to a rally, it would try to break. I'm proven wrong. The market, if we look at this break low right here, that was 102.90. Then we pulled back, you'll see. Challenged again. The 100-week average got to 103.70. And with this week's low of 102.80, we have a successful test. We have higher lows, higher highs, and momentum turned up. Until I see different, guess what? I say this market joined the bull camp, not the bear camp. And that theory that I had, it's out the window on the weekly chart that coffee might be leading what's going to happen in Europe and America. Cotton, still an export market, still down. This is one of them I'll be looking at. When I see this market wanting to turn, probably means that we're getting some Chinese buying, maybe other countries buying to do some milling of our cotton. We don't do a lot here. That'll be an indicator to me that things are looking better. In the cattle market, this has been a washout to the downside. There's a value. I don't know where it's at. I know that as a chartist, you're under the Bollinger Band here. You were this week under, if you look at it here, you were over the Bollinger Band, so you don't have big successions under it. We'll see if it can get back there. The trend's down. I think the pros were covering some shorts here, and I think it fell apart on them. I don't think they went long, don't get me wrong. I also think pro money took money off the table in the hogs you had coming in. Let me show you what I mean here. Lower highs, lower lows. What I preach. First time you hit a Bollinger Band on the upside, downside, is where I think pros take some money off the table. And I am assuming that with the bias, in order to get there, you're under the 18-week average. In order to get to the upside, you have upside bias. I would assume they're with that. And the market's come back to that 18-week average, sort of saying, maybe too cheap. Interesting thought process. All right, so as I told you, I start you off in the morning with my videos. Now, can you think of anything better? You're not going to see that many interesting things if you're shut in like all of us are getting in big cities now. So the idea is to still give you confidence in the trade. So each morning, I'm going to tell you, and I start off recording about 5:40 a.m., that's daylight savings time. And I've already seen what's going on in Asia, Europe, and I have an idea of what the U.S. economic data is looking for, what the COVID cases are at this point. So I'm going to give you the technical analysis along with the fundamentals, at least as I'm seeing them that morning, with specifics, if I like trade ideas, where to enter, exit, profit objectives, and always an idea as to where, hey, this trade's not working, this is the zone you'd be out on, or an exact stop. But you always have to know where you'd be wrong in a market. The winners seem to take care of themselves. The losers, unfortunately, don't. And if you don't take care of them, they take care of you in a very bad way. So the charts are going to look this way. They're going to be black, background like this with more studies. I'm always covering in this sequence. They're about 20 minutes long. And they're going to be specific. There's no generalities. Here I say, I think the pros are doing this, that. I'm going to tell you a lot different in this. I do charge for it, $7.95 for the first 30 days. If you decide to stay with it, it's $15 for every 30 days thereafter. You can get a one-year subscription that you pay it up front. It's the equivalent of $13 a month. And I'm also offering my charting course at about a 40% discount. But you have to have the subscriber video, and at the end of the video, I've made a complete whole explanation of the course with the codes you get that you need for the coupon to get the discount. How do you get this? Go to our website, under the word research, you'll see the explanation. Remember, I also now have a Spider ETF subscriber video. I've been throwing that in until I decide to start charging for it sometime in April. I'm Ira. You have a great weekend. I look forward to seeing you all next week. It's going to be worse before it's better, unfortunately, with COVID. Let's cross our fingers and get through this. Take care now.